Calling all beings. Calling all beings.
Hello, hello, hello.
Hello! Heidi ho! It's Thursday night, ladies' night.
Yes. And we also have Colleen here. Hi, Miss Demeanor. Good to see you. And we have Colleen. How are you?
I'm doing good. Thank you for having me on.
No problem. So I'm really excited to meet with you ladies. We know it's a new year. We got new savings goals. And today we're going to discuss some tips and tricks, right?
Yes.
Yes, so excited. And combined, I'm coming up on 30 years in the financial services, Miss Demeanor as well, or I don't know if you've surpassed your 30 years, but and Colleen as well. So combined, we have 90 years in the financial services area. So
We are an old man. Holy smokes. But we look good for being old.
Hey! That's awesome. So one of the things that I wanted to kind of touch on was credit cards, right? What do we use the most? I think like money is becoming extinct, and we use Apple Pay, we use credit cards for everything.
Yes.
So
I always think it's important that, because there are so many different types of credit cards, and it doesn't matter what financial institution you go to, they have like a wine menu of all the different credit cards that you can apply for and have. And so I think, and especially young people starting out, please, please, please make sure you ask your financial institution if they have a student card, a college card, something like that an individual that has no credit history whatsoever would be able to get a credit card and start building some credit for themselves.
Yep, 100%. And actually, I did that with my daughter. She went to her local credit union, opened up a credit card, and within 6 months, every other paycheck, she makes a payment, and she just got notified that they doubled her credit limit. So, these steps when you're young, if you know how to use credit wisely, this is a good learning opportunity where you can, work on getting your credit score up when you're young.
Yes.
So, and speaking of the different credit cards, so one of the things that with credit cards, you need to I would recommend you getting a credit card that works for you. Meaning if you like to travel, that's how you spend most of your expenses. You want the rewards to be for traveling, then there are great credit cards that offer those points, and you can turn them around and get some miles out of it.
I have a credit card that it gives me a point for every dollar I spend, and each month it goes into a retirement account.
Oh,
that's awesome.
I've never heard of that. Retirement?
Yeah, so it goes right into a retirement account, and so I put everything on that card.
Well, along those same lines too, they have the credit cards that you earn points based on where you spend money. So if you do groceries and gas, then there are some credit cards that, depending on the quarter, they run special promotions and you get double points for certain things. And then there are also credit cards that you get to pick what your particular categories are that you want to earn points. So it is super important to make sure that you check all of the options available, instead of, I want an Amex, just
right.
Make sure that you do some research, ask some questions, If you don't have a banker at your financial institution that you generally go to talk to about these things, you need to make sure you develop that relationship.
Absolutely. Absolutely. And, you know, the other thing to keep in mind, okay, great. We have a credit card. Perfect. Now let's talk about utilization. We really should try to stay within 30% of your utilization. So meaning if you have a $5,000 credit card, 30% of that is 1,500. So you never want to be carrying a balance higher than 1,500 because then that raises the utilization, which then raises your credit score. So
Lowers your credit. It lowers it.
I'm sorry, it lowers your credit. Sorry, I misspoke. Lowers your credit score.
Yeah, because it's all the numbers game, and it's a
is.
snapshot. So I oftentimes will tell people utilize the free resources like Credit Karma or My FICO. They will do like what if simulators and give you an idea. If you pay this card down by X, your score will go up so many points. So if you're trying to qualify for a new type of credit card or a loan or a mortgage, you have an idea of where you need to be for your credit score and how to get there.
Right.
And most financial institutions through their online banking, they also provide a simulator if they have any sort of access to getting your credit report or your credit score through your financial institution. I know most credit unions offer that. That's a great tool as well. And so because you can put in there, well, what if I got a new loan for $5,000? And it's like, oh, it makes your credit score go up 30 points, because that can happen.
Right.
Yes.
Right. For sure.
Yeah. The credit scoring models, like when you have ideally 3 trade lines with on-time payment histories for the last 12 to 24 months. The most important being your housing payment, because that is, you can explain away a late for this or that, but your housing payment is usually the one that you want to make sure you get paid and have no 30-day lates.
Right.
And the other thing with that
Throwing
too,
that out there.
the 3 different credit lines to have on your credit report. Also, you want them to be different. So you want to have an installment loan. And if you all don't know what an installment loan is, we can tell you. And you need a revolving account as well as a housing type of credit line that shows on your credit report. Revolving credit is credit cards. They give you a limit. You charge on it, you pay down, and then your limit comes back because you've paid down on it. An installment loan is like your car loan, where they give you $10,000, you make a monthly payment on that, and that is your monthly installment. Not everybody understands the difference between those. So
Yes, thank you for clarifying that. The other thing with credit cards that I like to do is set up recurring bills through your credit card. So your regular monthly expenses, if you're able to pay them with your credit card, then your expenses are technically earning you points, whether they be for rewards or and there are credit cards, as Janet was saying, that are based on cash rewards. So they will pay you back a percentage. And so, for instance, they have the categories. So one is like grocery shopping. They might give you a higher percentage, or gas. Those are the typical ones we've seen. So any thoughts about that? Instead of using your checking account, you recur the payments, you do the recurring payments, and also set up automated payments for that minimum payment on your credit card so that you're not late. Don't wait to get the bill. Set up the automated payments.
yeah, the only caution I would state toward doing that is if you are wanting to pay your balance down every single month, it is going to look on your credit report like you are carrying a balance all the time, because it's a snapshot in time that credit report is. And although you pay it, I try to explain to people, let's say you owe $50 and you pay the $50 off, and then the next month you charge $100 and you pay the $100 off. It looks like you had a $50 balance this month, a $100 balance this month, because you're charging right back on it again. It's not going to show a zero balance. So if you're interested in making sure that is going to drive your credit score, you want to do like every other month. Charge on it, then take a month off and show a zero balance. Then charge on it again, take a month off.
Right.
Because people freak out. They're like, I'm paying this off every single month and it shows I have a balance. I'm like, because you do always have a balance. You have a zero balance for like a day.
Right. But normal credit companies update the end of the month. So as long as you don't have a balance by the last day of the month,
Correct.
then you will be fine. So if you pay off all your debts within that month by the 30th or 31st, the last day of the month, that's paid. That won't have that balance going forward in your credit report. So that's a different, instead of waiting for the next month for it to be due on the 10th, if you have settled all your, all your expenses by the end of that month, and also you're not paying any interest, obviously, and it won't show that you have carrying a balance. What were you going to say, Colleen?
I forgot.
Oh. Don't worry, we'll be here all night.
My mind was somewhere else.
Were you thinking about?
I was just going to say, like, with paying off the debts and stuff, when it comes to loans, sometimes, like Janet was saying before, they like to see the installment loans on there. If you pay off an installment loan without replacing it, in essence, you could see your score go down. So if there's, something specific, a certain type of credit product that you're trying to qualify for, and you know what your credit score goal is going to be, definitely loop in, like you said, your financial institution that you're working with, and speak with someone there that can go over which products are going to, the best strategy for what you're trying to accomplish in the long run.
Also, everyone needs to be careful about closing credit cards.
Yes.
Paying them off and closing them. I would not advise individuals to do that. It's fine to pay it off. I do advise individuals to do that, but leave that account open. It's not going to hurt anything. It does have an impact on the utilization, your overall utilization, because it's going to show that you have, $5,000 available and you're using 500 of it. You close one of those lines that maybe it's $1,000. Now it's changed. It makes that a lower percentage and it's going to hurt you.
Right. Because the utilization is using what you have available credit that is open, and then calculating what you owe, and there goes your overall utilization. So yes, very important to keep that in mind. Again, the financial institutions are offering great, and consumers are more informed. I can't tell you how many times, people are just asking for credit line increases on their credit card just because they want to improve their score. This is a regular occurrence. So if you have the option to opt in for them to do the automatic credit line increases, it's definitely not a bad idea. They do periodic reviews on that, and they can increase your score if you have the option of opting in. A lot of companies too, what I've been seeing is if you have a credit card and you want a credit line increase, they won't do a hard inquiry. It'll be a soft inquiry,
right?
Which meaning it's not going to show that you were trying to apply for credit. And speaking of that, I also think we should mention, you don't want to be out there seeking credit and have all these inquiries. So typically, credit, every time you have a copy of your credit, you request credit, you're going to get an inquiry. If you have, it looks like you're seeking credit and you want to apply for 5 credit cards this month, not a good look, because now we're kind of thinking, the bank's looking at it like, hey, are you in financial hardship that you're now wanting to open all this credit? So make sure that
we're actually
too many,
just getting out of a really scary time for consumers for this to happen. And I don't know if everybody is aware, but when you're checking out at Kohl's and they say, hey, we can give you 20% off if you apply for a credit card today. That's a hard inquiry. Then you go to Ulta because you're doing your Christmas shopping, right? And they go, hey, we'll give you 20% off if you apply for a credit card today. And now you've got a second inquiry. And that goes on and on and on. And people don't always realize that holiday Christmas shopping time of year that you can get into a dangerous place just with inquiries.
Right.
And yeah, it sounds great. Oh yeah, I'll take a percentage off. But
Well, speaking of the soft inquiry, though, every Massachusetts resident is entitled to one free copy of their credit report from each bureau every year. If you go to annualcreditreport.com, you don't necessarily have to pay for your score. You know, you can kind of get a gauge of what your scores are by going somewhere free, like Credit Karma, for example, or one of the other, like there's My FICO, I think Kick is another one. There's a bunch of different resources out there that will give you an idea of what your score looks like. But I always try to order mine around the time I file my taxes every year, just kind of like an annual checkup. I get a copy from each bureau mailed to me. If there's any mistakes or something that's not correct, I can dispute it right then and there. You can do that by going online or writing them a letter. But they have a certain amount of time after that to respond to you, to investigate, correct it, and respond to you. So it's always best practice if you're disputing something and you have the paperwork, send them the paperwork. And, you know, because you never know when you're going to need your credit score to be good. Usually, you know, when times get tough from one life situation or another, that's not the best time to ask for credit. And that's probably the time in your life that you need it.
You get the credit when you don't need it.
Yeah,
Exactly.
so it's more like your own personal soft inquiry to keep an eye on it and making sure that it's accurate. So you can request the credit when you can qualify for it so that you have it available when you need it.
Murr is asking a really good question. I have Amex from 1974. I want to close it because my yearly fee is $350. Any advice? I would say call them and raise some cane that you have been with them since 1974. Why are you doing this to me? I'm a loyal customer. And there's a good possibility they have another type of credit card that they can convert your existing card to, so you don't lose that. And then you can eliminate that annual fee.
Yes, because the length of credit history of on-time payment history is huge. So on-time payments since 1974, if you close that, it doesn't exist anymore. And so your score, I think, would probably go down. And the credit utilization would go up because whatever the available balance on that card wouldn't be available anymore.
Right.
I would definitely try to negotiate the fee since you've been with them for so long.
Right. Right. And especially, I mean, if you have good credit, you shouldn't really have to pay annual fees. Let's keep it real.
Well, they get you, especially in that situation. She's been there so long. They've just been doing it.
Charging.
Exactly. And because she's not saying anything. I assume Murr is a she. I don't even know. I'm sorry if it's a male. My apologies. But squeaky wheel gets the oil. So call them up and start squeaking.
Yeah. Worst thing they can say is no.
Exactly.
And then you do the, you do the pros and cons.
Right.
At that point.
And then whether you choose to open up a new one because those rewards are better, you can still leave that Amex. Those have to be paid off monthly. So,
if it's a points or a rewards type of card, you can use your reward points to pay the stinking annual fee. So then you're not out anything. So that would be an option as well.
True.
That's true. Yep. All right. So since we're touching on credit scores, so what about, I think one of the things when you're buying a car, right, you show up to the dealership and, I'm going to finance a car. Okay, great. Now they get you for like 6 inquiries. Mm-hmm. You have control over your own stuff. Like they don't tell you that you have options, but when you fill out a credit application, you can ask the financial person, okay, what companies are you using? What and just to ask them, okay, they'll have the list of obviously lenders that they use, right? You can say, all right, I'd like to go with this bank, and I would like my credit only run once. Why should you take a hit? Which it looks like to us like it'd be a cluster on the financial side,
Mhm.
but a cluster, so they really don't. It's not held against you because it obviously looked like you were buying a car. But as a consumer, you have the right to say, I would like to apply with this company. Can you only run my credit with this company?
The
Exactly.
other the other thing I would recommend, and I have recommended several times in my career, go to your financial institution. This kind of goes back to get a good relationship with someone at your financial institution. They should be your partner in getting your financial goals met. And
Mhm.
it is a whole lot easier to go to that person in your bank, go to your banker and say, hey, I'm going to start looking for a new car this weekend or a used car this weekend. Get me pre-approved for
Yep.
whatever it is. And then when
Mhm.
you walk into that dealership, you have taken a bunch of their sneaky tactics away as far as trying to get fees on the back end or interest built on the back end and things like that. You're in more control by going in already knowing this is what I am willing to pay. This is what I'm already approved for. I just need to know what you have available.
Exactly.
Yes.
Exactly.
And depending on the financial institution, you always want to double check with what year your
Yes.
pre-approval is good for, because newer cars have different rates than older cars. And
And
some,
some,
they'll only go back so far, so many
exactly.
years.
Yeah, I was going
Yeah.
to say, and some financial institutions have a cutoff. If the vehicle is older than such and such age or year, then
Yeah.
they won't finance it. So yes, that's why it's super important to have a financial partner in your financial institution that is working as hard to make you money with your money as you are.
Right.
I
Exactly.
saw the question at the bottom. I can touch on that if you want.
Sure.
So usually if you go to get pre-approved, um, I have the ability, some lenders don't, but some do, to do a soft pull. So what that means is that instead of doing a full hard inquiry tri-merge credit report to do your pre-approval, we pull one score from one bureau, and it's a soft, so you don't get dinged on your credit score for that. The caveat being that once you're pre-approved at that score, you certainly don't want to drastically change your credit profile. If you're paying stuff off and your score is going up, great. But you don't want to get your pre-approval, for example, your score is 680. I have to ultimately use the middle of the three
Yeah.
scores.
Right.
So I have to hope that 680 is your lowest score when I'm doing the pre-approval. That's why it's also important to check all three bureaus, because if Experian and TransUnion, which I think is what Credit Karma reports, both have you at a 680, but Equifax has a collection on it that the other two companies don't know about. You know what I mean? And your score could be drastically different.
Well,
Um,
also it
but
depends
we
on
do the
where.
soft pull for that reason. So that way you're
Right.
not digging your score while you're searching for a home, because that could take, months, years in some cases. Most soft pulls or credit, even hard pull credit reports, expire after 120 days.
Yeah.
Bank statements and pay stubs generally 90 days. So that's where you'll see that. It varies sometimes from lender to lender. Some are stricter and say 60, but
Right.
for the most part, 90 to 120 days is how long you can get pre-approved for,
As
ideally.
far as the three credit bureaus too, this is something because I have lived in different locations. You could have a very, very big difference between credit bureaus because, like when I lived in Michigan, and I don't remember now, I think Equifax was their main credit source. So everybody that I did anything with while I lived in Michigan showed up on Equifax, but almost nobody used TransUnion.
Right.
So my TransUnion had like 4 credit lines on it or something. And, Equifax had 13 or something like that. So it's possible to have a very, very big difference between those scores. And it's not that you've done anything at all. It just is dependent upon where you live. When I moved to Tennessee, then my Experian score was like phenomenal, because everybody there was Experian.
Right. And the other, so here's on the DJ wanted me to touch on this. So going off, staying on the topic of car loans. So I have a practice that I have started is that when I go to purchase a vehicle, I no longer am trying to buy the shiny, brand new this year car.
I want last year's rental with like 1,000 miles on it.
Exactly. Because when you buy exactly. So when you purchase a car, the minute you drive it off the lot, you're already down. You're already in the red. Okay. They depreciate so much. So what I started doing and to get myself into a more luxurious car is I will get one that's like a certified pre-owned, a lease that got turned in, because if you notice, if you've ever done a lease, those vehicles are taken care of. Their maintenance has to be done on schedule. Those vehicles, if it gets a scratch, you have to fix it. Like you have to stay on top while you're leasing. So they say somebody, returns a 2-year or a 3-year lease. You're talking about around 30,000 miles that they have. In those vehicles, you can get yourself into a $60,000 vehicle at this point, maybe in the high 30s. So you can, again, your money. A car that's 2 to 3 years old is just barely broken in. You know what I mean? So that's usually what I do. I told DJ that he ended up getting himself into a vehicle and didn't pay a lot of money for it. And it's working out.
Don't talk bad about my truck.
I didn't mention the brand, so don't go there.
Can I praise Boston Bia? Basically, what she did is I was in a Honda CRV hybrid that had pretty close to 90,000. We were in the 80,000 mile range, and it was struggling here in Colorado. It's very high altitude, a lot of hills. And I was interested in this Hyundai truck. So I got, instead of buying a brand new Hyundai at $44,000, I traded in my used 21 CRV this is kind of at even though she's not a Hyundai fan, she said, go for it, because this is what you want. So I traded in the high mileage CRV for a 2024 Hyundai with, I think it's not even at 36,000 miles. It was at 20 something thousand miles, 2024, completely loaded Hyundai pickup truck. So it really worked for me. If I would have gone and bought a brand new one, I would have paid $44,000. And I got it I gave him 10 grand plus my CRV and walked out of there.
I did similar because Ms. Demeanor's bougie. I don't know if y'all know that or not. But, I bought a 1-year-old Maserati. So, for that, and it had 5,000 miles on it. So it was literally brand new. And I had so many people give me so much grief about it. And I'm like, I don't think you realize it. Your full-size pickup truck costs way more than my Maserati. And mine's an SUV. I'm an SUV girl. And
me too.
But yeah, I'm from the Motor City. So, what you drive is part of your identity. So, I'm bougie about my car. I'm sorry.
I drive a Kia.
And some people don't care, and that's okay.
Right.
My first Kia looked like a BMW. It was like leather interior and wood grain. It was an Optima. It was so awesome. And I drove it into the ground.
Hey, Kias are good looking cars right now. I'm many times I'm like, what is, that's a Kia. Oh, that's a good looking car. Yeah,
Right.
I'm all about how sexy it looks and all of that. Yeah.
It checked all my boxes. And so, to your point, like last time I had to get a car, I was just like, I'm going to get my pre-approval from this place. I'm going to walk in there. I'm going to tell them I want the used, low mileage. There were 3 of them. They were all, this was in, I think, January of 21, and they were all from 2018. And there were 2 white ones and a blue one. And I said, which one has the lowest mileage? And it was like 17, 17, and 16. So I ended up with the blue one. For like 23.
That's the way to do it. And I see someone said, I love my Mercedes. I think it's Please Pass the Pepper. I love my Mercedes. I named her Spite. My Maserati is called Pearl. So Pearl takes me everywhere I want to go. I treat her very, very well. So yeah, I always name my cars too. So
that's funny. I always refer to them as a she, but besides that, I haven't thought to name her. But
years ago, I had a Dodge Magnum, and that was definitely a dude car. I mean, it was a cool vehicle. But yeah, it was a dude.
Nice. But again, that's making not without taking the depreciation, let somebody else take that depreciation.
Absolutely.
When they return those vehicles, they don't have, and some people just, and I have to say that some people just have a car for a long time. You buy yourself a new vehicle and you don't like it. And that happened to me twice. After having one vehicle that I drove for 150,000 miles, the next vehicle, the way it looked beautiful, but it drove differently. And the 4-wheel drive thing, it's like, I didn't like it. I traded that in and then traded the next one in too, because now it was too low to the ground. I wanted a higher SUV.
I know. And I will say my Maserati is 5 years old now. So I'm not one buying a new one every year or anything like that. It had 5,000. I hardly drive where I live. And so I have like 26,000 miles on it. It's 5 years old.
That's awesome.
Yeah. I'm like, I'm golden.
Yeah. And I'm
Pearl's
sure
gonna
Pearl
be going
looks,
a long time.
I'm sure Pearl looks beautiful. Yeah. All right. So let's see. Oh boy, he's back. Oh no.
Yeah,
and now you're back.
We have a question. I don't know if you guys can tackle this one. This may be out of your expertise. This might have been more like a Nan Gallagher.
Oh, tenants' rights in New Hampshire. So
I am of no assistance whatsoever. The only advice I could give is check local government websites.
Yes, tenant rights. Okay.
I know an attorney that covers Mass and New Hampshire, Erin. So I just messaged you some contact information. If he can't do it, he'll know who to get you in touch with.
Awesome.
Right. Yeah, that's more of an attorney, because if you're looking for tenants' rights, that they probably have somebody who's not paying rent and have to take action. And that's the thing. Tenants sometimes have more rights than the actual, because you can't just throw out somebody out in the street. And if you have children, there's, so that's a whole thing. All right. So let me talk. So why don't we get into our favorite subject, mortgages.
All day, every day.
Yes. So where can we start? So let's say we have somebody that's coming to you for a pre-approval.
Okay.
Where do we get started?
The first thing I like to ask them is, what does your credit look like? Right? So we just had that conversation. We kind of go over that. And if it's in a range where I know I've got a program for it, we say, all right, let's do a pre-approval application. We'll do the soft pull. We'll see what the numbers look like. We collect income docs and asset docs. And that's basically, I do all the math. And, sometimes, for example, someone will say, oh, well, I can't find a place in such and such an area at that dollar amount. We have the conversation. Okay, do you look in a different area? Do you pay stuff off to qualify for more? things of that nature. We look at what programs do we qualify for, and out of the ones we qualify for, which ones have the best rates right now. Um, Rates is something that a lot of people can get hyper focused on, and of course, everybody wants the best rate. But I could tell you what the rate is. I could tell you what the rate was when business, ended at 5 p.m. And then, I don't know, I got an email. Trump said something. We might benefit from that in our rates tomorrow, but maybe not. Maybe it might be completely upside down. We'll see what happens. So, when I discuss rates with borrowers, I usually talk about what the current average 30-year fixed 30-day rate lock scenario is, or an ARM, or whatever program they end up being in. And we kind of go from there. And at that point, at least they have their pre-approval with the dollar amount of how much they can borrow and what purchase price they can afford. Once they actually, find a place and go under contract, that's kind of where I get brought back into the mix. And then we recalculate all the numbers to the specifics to that property and that, review
Right.
everything. Is there a new program? Is there a better thing? Is there down payment assistance? Is, all the various things that, that
Right.
inevitably everybody has questions about,
And the one good thing about when you're pre-approving for a mortgage is that you can say, I want the max that I would qualify for. So you'll have a commitment letter that says, I can afford a home up to 400,000. Now,
Yes.
I will
Some
give you
people
one
say
piece
the
of it.
max, and I tell them, and they say, I don't
Yeah,
want to pay that much. I said, well, I'm not going to
exactly.
make you buy a house that's that expensive,
Right. But
but we work the
yeah,
numbers backwards and figure out, okay, if you want, say if your rent's $3,000 right now and you can go buy such and such a property and your monthly housing payment's going to be $3,000, then let's figure out how to get there. We just work it backwards.
right. And the other thing too is that let's say you are approved for $400,000. You don't have to buy a house that's $400,000 if that's not what you want. You also don't have to present a commitment letter that says $400,000. You can go to your loan officer and say, "Can you update that amount and bring it
Yes.
down?" Because it's hard to
And that's the
negotiate.
offer price to the pre-approval letter, so you don't show your hand.
You don't want to show your hand. So that again, you go initially to the bank, they issue you a letter, you can afford a $400,000 house, but now you're looking at condos and they're in the 250 range, right? You don't want to let them know that you have a pre-approval for 400,000.
Right.
They
And
can
also,
update the letter.
what is the pre-approval for? Is it for a condo or is it for a single family? That's an
Right.
important factor too when you start looking,
Yeah.
which is, more I would redirect my borrowers, to go back and talk to their realtor about that stuff. But, your principal and interest, taxes and insurance on a single family. And then with a condo, you also have an HOA fee. So you could potentially qualify for a $600,000 single family home or a $400,000 condo.
Right.
Because
Right.
this condo, you're looking at might have a $350 a month HOA fee. The one over here, it might be $900 a month. So that's really a
Well, and
conversation that you want to keep on going, especially if you intend to look at condos. You
well,
want to
and
keep it going
depending on the area that you live in too, can make a huge difference on what taxes and insurance now I feel like is a big, huge question mark for a lot of people because insurance costs have gone up so much. So if you thought your insurance was going to be $2,400 a year and all of a sudden you find out it's going to be $4,800 a year, that's a significant difference in a monthly payment. So that's going to lower your borrowing power because of the debt to income ratio and needing to make sure that your payment stays within an approvable amount.
I often tell my borrowers, shop around, check with the agent you have your auto insurance with now. Here's a couple of other people you can, see what they say, because each agent might have access, one agent might have access to 5 carriers, another agent might have access to 30. And they might be able to say, okay, instead of $1,000 deductible, if you go up to $2,500, you save $1,000 a year. So
Right.
it's like, okay, if I have a claim, if I have to actually put in a claim on this house, how much am I willing to budget and like stick in the bank
Right.
to cover that deductible? And, you know, like for me personally, I was like, okay, if I'm worst case scenario, I have to put in a claim with my homeowner's insurance and I've got to pony up $1,000 on a, I have to put it on a credit card. I'll just take the 2,500, you know, like if
Right.
I'm at my worst and I have to put $2,500 on a credit card, I just need to make sure I have that available in case of an emergency.
Right. And depending on how,
It's to save
if
you
the
money on your
higher,
insurance policy.
right. And the higher the deductible, the less your premium's going to be too. So your premiums gets adjusted. And if you go and you use the same company that you use for your automobile, then you can get some additional savings if you're using the same company. Yep, the bundle discount. Yep. The other thing I was going to mention is some things that you shouldn't do when you're in the process of looking for a home. This is not the time to go shopping, people. It's not the time to buy new furniture. It's not the time to buy a nice shiny car. This is the time to wait until you close.
Do's and don'ts.
Exactly. So this is what you don't realize is that your credit gets pulled initially. The company issues a commitment letter. Now it takes 45 days to close if you find your house right away. And just before the closing, they're going to run your credit again. Guess what? Don't shop for furniture. Don't increase your debt. Don't go spending. Don't leave you can buy the curtains when you have the house.
Don't buy a new car.
Exactly.
Oh my gosh. Yes.
Yes.
I've had people and they're like, I got to get to work. I'm like, can you rent a car for a week? Because if you buy a car today, we're not closing on the house next week. Like, you know, it's definitely keep your loan officer or financial, you know, contact in the loop on stuff like that, because sometimes we can come up with, you know, do we need to close sooner? You know,
and I just saw a comment about I'd never do an HOA. Be really careful with that. I have an HOA where I live. It's $395 a year.
Oh,
and it's to take care of we have a beautiful front entrance. We have a little park in the middle of the small subdivision. I'm perfectly happy paying that $395 every year to have that nice prettiness around me. So you just have to pay attention with homeowners associations. Condos are always going to have them. That's just part of being a condo owner. But some of them are a little more, what's the word I'm looking for? Militant about things.
Yes, I was going to say, do you have any restrictions on your house color and if you want to change your front door?
We really don't here.
That's good.
Wonderful. It is. We really lucked out when we picked this home. So, no, you know, we're butted up to a golf course. So there is a requirement on our fence, how high we can have the fence in the back, but on the sides, we can have a higher fence. They don't want it to look like big, nasty privacy fence while people are out golfing, you know,
Gotcha.
And I get that. So no, HOA here is wonderful, but I lived someplace where it was awful.
Yes. So when you're part of a condo and that roof needs to be replaced, well, guess who's paying for it? Everybody.
Yep.
Whether you're ready for it or not. So it's and then your fees goes up. Those can go up at, you know, you
get a special assessment.
A special assessment for, you know, if they have to replace the windows, everybody's windows are getting replaced, whether you want to or not.
And depending on what certain condos, they will also review and make sure, especially if you're in a condo that's rentable, meaning that you know, it's in a vacation or tourist area, they will require you to upgrade your condo, even if you don't want to. Like, okay, we know you have the linoleum and we know that you have these nice Corian countertops, but we want quartz now. And we want tile floors. So take it out and put what we want in. So you have to be careful with that as well.
For sure. And What were you
I
gonna
was
say?
going to say, please pass the pepper. You could actually, a lot of bank websites will, if you go on to their particular website and search foreclosure or REO for
Yeah.
real estate
State
owned,
owned. Yeah.
they may have links within their websites. You could also go to,
County
for
clerk.
example, the town clerk or like masslandrecords.com and search by the name of a lender, Fannie, Freddie, so on and so forth. Because if they've taken ownership of the property, they'd be on the tax records. So,
Right. You could definitely get some good deals on a foreclosure, but you, again, like with everything, you have to read the fine lines. Sometimes they make you pay those back taxes that haven't been paid as part of, now you, the bank, and that's the thing. The
they
bank does
won't let
not
you
want to,
fix anything. It's so
right,
backwards sometimes because, like, it'll say, "Hey, it's a HUD-owned home," and then,
right,
okay, FHA, for example, owns this house. It's been foreclosed on, so I have a buyer who's approved in an FHA loan, but FHA won't let us close on the foreclosure until, say, like the septic's replaced. We say, "Okay, well, we'll replace it after closing." No, you have to do it before closing, but we're not going to let you do it before closing. It's like, okay, now we have to get a rehab loan and we got
it
so
gets
sometimes
complicated.
foreclosures can get complicated if you don't have a lot of liquid assets to do things
Right.
to get it to be a lendable property.
Right. Because so as you can imagine, a foreclosed home is one that somebody stopped making the mortgage payment. Somebody's not paying taxes. If they're not making the mortgage payment, they're not doing the upkeep or maintenance on that home. So those homes are, start to get, they stop mowing the lawn. Like they have no incentive if they're losing a home to keep it pretty. It's just not going to happen.
Nope.
But you can definitely get good deals. And I mean, but here's the thing, like if you have if you have access to taking a mortgage on your primary home and using equity and then going to buy a foreclosure, that might be a good deal because you might be able to get a very good, property and if you're at a good price.
Something else to keep in mind is, well, I did see a question. DCN 43 is saying, my 30-year-old son has a PMI as first-time home buyer. Can we talk about this?
Yes.
Yes, yes, yes. And make sure you are paying attention to the value of your home and what your principal balance is on your mortgage. That's what you can tell your 30-year-old son.
You can call the loan servicer and say,
yes,
I have more than 20% equity. Take the MI off.
Take that off because they're not going to on their own. You need to be the squeaky wheel again.
And FHA, if you have an FHA loan, they don't do it for like 11 years. So oftentimes it's great program to use to get into a house with the intention that when you have the opportunity, get out of it because, even if you go to a conventional paying less mortgage insurance,
right?
Because with conventional, you can call up the loan servicer and they do a lot of times they just do an automated value. They don't necessarily have to send an appraiser out.
Right. And usually those have a 2-year seasoning. So from the time you purchased your home, you can't request for them to reevaluate for 2 years. So that has a 2-year seasoning. And then at that point, you can call, if the values have gone up, call your lender and they'll,
I'm seeing DCN says he's had it for 4 years, plenty of equity, major updates. He needs to get on the horn ASAP. Like you need to get off of this live stream and call him.
Yes.
Have him call me.
Yes.
That's the thing is people don't understand or know. Woohoo! They don't understand or know that you have rights. You have the ability to have some control over this. You don't have to just sit there and let your finances be run by financial institutions or mortgage companies or lenders or whatever it is. Get yourself educated.
Work for you because I got to tell you, some people are so dead set, like I said, on certain things, one of them being, 30-year, I want to pay it off in less, or I want to pay this off in 10 years. Well, you can take a 30-year loan and I can tell you how much extra to pay each month to pay it off in 10 years, so that you have that liquidity available and you're not.
But you're obligated for a lower amount. Yeah.
Right.
And
Most
that's the
people
thing.
don't stay in the 30-year mortgage 30 years anymore.
No.
On
No.
average, most people sell or refinance every 5 to 7 years.
Yep. 100%.
Depending on, but then sometimes life happens and you have to replace a roof or you need to get an equity line and now you need to consolidate it. Now the rates went down, like
Well,
COVID was like
and along those
up one
lines
day,
also,
everybody was refinancing.
along those lines also, with all of those unexpected expenses, it's not a mortgage, but again, if you have a really good relationship with your banker at your financial institution, they should be talking to you if a situation comes up like this, talking to you about a home equity loan, and whether that is a home equity installment loan or
Yep.
a home equity line of credit. Those are at great rates right now. And it gives you a lot of flexibility. A lot of financial institutions are offering promotions for a period of time to have a lower rate. They're great for consolidation, great for home improvement, great if you are looking to buy a second home and you want to just use the equity in your current home as a down payment.
Generally, they're attached to the prime rate. So the prime rate,
Yes.
which is when you see these, news reports about the Fed meeting and all of that, the prime rate is coming down.
Yeah.
So
Where are we at with
that
the
is
prime rate
good.
right now? Do you know?
6.75.
I was
I
going to
believe-
say it was at 7, and then I thought they did a 0.25% reduction.
Yeah, let me see.
Yeah, I haven't looked at the prime rate, but yes, it's definitely a good way. Like for me,
6.75. They just
Okay.
from
Wow.
7%. So it's going to start going back down. And so, it's good for like equity lines and things like that. If you're a saver, you'll notice that like if you have CDs and things like that, when the prime rate was higher, your CD rates, your rate of return on your savings was higher. Those are going to start coming down. So that might be a good opportunity to speak to someone about locking in at whatever the CD rates are now for your savings before they go down.
Something else I don't want to forget while it's popping in my mind, it's kind of, I don't want to say it's off topic because it's still financial, but along the lines of the CDs, a couple of things. Also check with your financial institution. If you do have money sitting in a savings that you don't want to touch, but you are looking to purchase something, use your CD as collateral to get a really kick butt rate on your loan, because most financial institutions will charge you a percentage over what the interest rate is that you're earning on your CD, on the CD itself. And usually it's 1 or 2%. So you're basically borrowing that money for 1 or 2%. There is nothing better than that right now. So if you do have money sitting someplace, that's a great way to maximize what your savings is and still be able to have some buying power.
Right.
The second thing with CDs is a lot of times people think that the banks automatically, if the interest rates go up, then that means every single financial institution is going to increase their rates on savings or certificates. That's not always the case. And the reason that exists is because financial institutions have to have a portfolio that looks, that's made up a certain way. They can only have so many deposits. They can only have so many loans. And so that's why you'll find certain financial institutions with these screaming high interest rates on a CD, and nobody else in town is doing that. It's because they're trying to drive those deposits up because they probably have a lot of loans and they're needing to balance that out so that they have the proper portfolio mix.
Right. And yes. So, and the other thing with CDs, when they come due, sometimes the company automatically renews it. That's your time to take a look. Maybe I could get into a 6-month CD at a higher rate. Don't just take whatever it gets rolled into again for the same term. So make sure that you're always checking once those CDs come due that, hey, what options do I have? Maybe I put it in for a little bit longer and get a higher interest rate.
Well,
Call and ask.
Another trick, and I see Aaron, I'm not even going to try to attempt the rest of that name. It says, I got penalized so much because I kept digging into it. Here's how you get around that. Let's say you have $20,000 and that you want to put into a CD. Don't put $20,000 in a single CD. Put $20,000 in 4 $5,000 CDs, because then if you have to dip into that, your penalty is only on $5,000 instead of $20,000 for the penalty. So again, make your money work for you. There is no rule or law or anything that says you have $20,000, you have to put it in a single CD. No, break it
or
up.
stagger
Make it
them
work.
too. You can make them stagger them. So if you have your $20,000, start one in January, the next one in March. Like have them staggered, so when they come due, you have money that's coming due every so often that you can
avoid the penalty.
Right.
Yes.
Exactly.
Sorry, I got us all off track on CDs. Sorry.
No.
I was going to say, so auctions, I would talk to it's definitely a realtor that's familiar with how they work. Some auctions, like if you write that check and then it's a nightmare, it is your nightmare. It's no longer their nightmare. And if you walk away, they keep your money. So you definitely want to do as much research as you can on the property. Sometimes they still have people living in them. And then if you buy it, if you're buying it with financing, it's going to be difficult because if we can't get in to do an appraisal or a Title V or things that are required when you're getting a mortgage, you could run into issues there. But I mean, I've done some auctioned properties that people purchased, and I mean, it was a lot more paper heavy. They oftentimes the auctioneer, if you will, or the website will make the buyer pay a certain fee or cover certain fees in excess of what a normal closing cost scenario would be. So you need to keep an eye out for that kind of stuff. But I mean, it can be done if you have a good team that understands the ins and outs, and you could be totally prepared for everything, and then inevitably something's going to go sideways and everyone's going to get aggravated because usually it's a real estate owned property and it's owned by a bank or an institution, and they don't want to let you in, and they don't want to do this and they don't want to do that, and so it's risky. It's risky definitely for savvy investors and
yeah,
not stuff.
Not really your
I would
homeowner.
recommend it for like first time home buyer type.
Right.
It's
And
a lot.
typically
could it be done? Yes, but it's
right. And typically and first time home buyers don't always have the reserves to be able to do all the fixes. That's the problem, because you're using all the money you've been saving after paying rent, and you don't have the money for all these things that have to be taken care of. How much extra should you pay on your car note to pay it off early? Well, that one's not too hard to figure out. I mean, it depends on, because
I feel like you really need to find out for yourself what your budget will allow, because 50, and you can, this is another little tip, tool, trick, whatever. There are things out on the internet that you can go to. They are called amortization schedules. You can run an amortization schedule that shows you, if you paid $50 more each month, how long will it take for me to pay my balance off? So go out and play with that stuff and find it. Educate yourself. Become knowledgeable about your money, because it does make a difference. And
sorry, I just wanted to jump in really quick since you mentioned the schedule. If you've got any kids in the house and they have the calculators for school, you can actually do, I don't know if I can get this to show you, but it says loan amount, payment term, and interest rate. And you can actually do it right on your calculator and play with the numbers.
Yep.
And then on a mortgage, I know the answer. 1 biweekly payments gets you 1 per year, one extra mortgage payment. The other thing on mortgages, before I forget, it's always a good idea to make your January payment in December, so you get can claim your interest for 1 more month out of that year.
Good
and
good to have your stuff set up. I cannot stress this enough. Do it for before the 30th, because the 30th is the 30th day, and if you like someone I know was like, oh, I always go in person and pay it on the last day of the month. And I'm like, well, July, it was late. Every month days it was late. I'm like, yeah, so it's not, it has to be by day 30. So that's always
And something else people don't understand is paying on the first 1 month and then the next month you pay on the 17th, and they're going, well, how come there was almost my balance didn't go down? Yeah, you had 47 days or 46 days of interest instead of the 30. Like, you got to pay at the same time every month so that interest doesn't get all messed up, because if it's early in the loan, you can create a negative amortization for yourself, and that's not good at all.
Yeah, those aren't good.
Right. And mortgage interest is paid in arrears. So when you're making your January payment, you're paying interest for the month of December. So, and whether you pay it on the 1st or the 10th, you're still paying the same amount of interest. So some people have this notion that if they pay their mortgage, by the 1st, like, oh my God, I'm saving. No, you're not saving, because it's previous month's interest. But definitely within your grace period, definitely set up for automated payments. Most mortgages, you have a 15-day grace period. So whether if you pay it on the 1st or the 12th, it's still always paying the same amount of interest because it was for the month before.
Right.
So.
And Mer's question.
Yeah.
This is a home equity loan. Run to your financial institution.
I would do the line of credit unless you absolutely need to use the money for something right now.
Correct.
Or if you can borrow it at a rate and then put it into some sort of account where you're going to generate a higher interest rate of interest, an equity line is probably a better fit. And that works basically like a credit card, but it's just attached to the equity in your house. But you do have to, pay it, or
usually there's
spread it off. They'll foreclose on your house. So equity line is attached.
Usually there's a 10-year drop period on equity lines. Yes. So basically it works like a credit card on your house that you're only paying interest for what you use. So if you
only you should pay more. Yeah, you never want to.
Oh, of course. But I'm just saying the minimum requirement is interest only. So what you probably want to make sure that you're doing is, if you need home improvements, and then later on, if the rates were to come down, you could always consolidate them. But, right now, if you have a good interest rate, definitely don't do a cash out refinance. Take out an equity loan and a HELOC or HE loan. So the difference between a HELOC and a HE loan is a HELOC works like a credit card where you're drawing against the amount you were approved for, and a HE loan, which is a home equity loan, is when you go to close, you're given a specific amount, and then you start paying principal and interest as soon as the first payment's due. So it's an installment loan versus a equity loan.
401k plans, when you leave employment, roll them over.
Yep.
I always make a new employer.
Yep. You only want to have to go to one place to get your money when you retire. Yes. So yes, keep rolling it over.
Investment gold. I can tell you, when the young ones in my family, nieces and nephews, I wanted to give them savings bonds. The crazy financial lady in the family, she's going to give us savings bonds on our birthdays because they didn't need toys and gifts and that. Are you kidding me? So I decided very early on and started to buy them silver coins for their birthdays every year. And so I can tell you, if you look on a chart, the silver, it's got a way better return than a savings bond. So I don't know about gold. I haven't looked into that, but I can tell you, I have one nephew that is going to be turning 18, and he has 18 silver coins now from every birthday. You can get them. I get mine on AppMex, and they've got different designs. He was into baseball, so some of them have baseballs on them, and they're trust me, You're not going to lose your money on silver
There you
or
go.
gold. I don't think you'll lose your money on gold either.
Right. They might just be a little more expensive to buy, right?
Correct. Yes. The
Yeah.
initial investment will be more.
Right.
Why does
So,
your credit score drop when you pay it off early?
Oh, I think we went over that earlier on
With
an
the
installment
utilization.
loan.
yeah. So, yeah. Do you want to expand on that, or you think we covered that one already?
Oh,
I feel like we covered it.
Brenna wasn't here.
Oh, she
Oh.
needs to
So
go back to the beginning.
I wanted to shout out Brenna. First of all, Brenna is helping us put together this next fundraiser that we're doing, and she's been working with Ian Runkle. So thank you, Brenna. And just for you, we're gonna answer it again.
Ian Runkle. I love Ian Runkle.
love Ian. He's great.
I want an introduction to Ian Runkle. I adore him.
How about you come on the fundraiser and then you can meet him on the
You
fundraiser?
know I don't do that.
And DJ.
Well, we're fundraising. You're just there.
Oh, DJ. Okay. So, yes. So the reason why is because, so we're talking about credit cards, I'm assuming, right? This is back to our credit card conversation. Because an installment loan, if you pay it off early, that's not changing, doing anything.
Yeah.
You
It can
pay
drop
off an
the score
installment
if
loan.
the mix isn't the same.
Right.
Well,
If
and
you
it can
close
drop
one
your
loan-
credit score if you haven't had that installment loan open at least 6 months. It will hurt you. So you want to, if you have an installment or a car loan, same thing, installment loan, you want to have that open for at least 6 months. If you do it less than that, then it's going to hurt you. So don't do that. Even if you have the money to pay it off, just keep paying for a year.
Yeah. They like to see the on-time payment history.
Yes.
So in essence, paying it off, you're not in as much debt, but then the creditors don't know how credit worthy you are because they
Right.
can't see that you can pay something on time for an extended period of time. And that's part of their scoring models.
Right. All right. Let's see what else do we have any more questions, DJ, that you want to bring up for us? The other thing we should probably mention too is it's, teach your kids as soon as you get your first job, start saving for retirement.
Mm-hmm.
Well, absolutely. And the other thing I will tell you, again, most financial institutions have access to this program. It is called Greenlight. I don't know if anybody on this panel is aware of it. Greenlight is an app that you can connect with your child, and you can set like chores that they can earn money, and that money gets automatically deposited into their Greenlight account. And then they learn on their own in a safe way where you can control things, how to budget and how to manage money, how to earn money. Maybe if they get a certain number of grades, then they earn X amount of dollars. Or Greenlight is available at almost every financial institution. Again, that relationship with your banker, you can ask them about it. But it's a great, great product and service for young people and to learn how to budget, how to save, how much things cost.
I actually saw something the other day, and I don't know if it was really Elon Musk who said it or, whatever, it was a meme, but the math worked. And it said, if when your kid turns 18, if you have them pay you $500 a month in rent, right, you document it. So now going forward, you have a rental history you can show to a mortgage company to get a pre-approval, and qualify for those programs that require rent verification. But if at 18 you start charging $500 a month, by the time they turn 24, you can gift them back their $36,000, which would be 10% down on a $360,000 house. My daughter's about to turn 18, and I'm like, you're going to be here for the foreseeable future. You can't afford a $2,000 studio.
Right.
Never mind, every food and everything else. Even that's based off like full-time minimum wage. Full-time minimum wage is like 33 grand a year, if that, and then you do the math backwards, it's like,
Depends on what state
yeah.
you're in.
I'm like, you're gonna move out when you're 40, like, or you're never gonna leave. You'll just inherit this, and you'll never have to move again. But yeah, I told her that. I said, if you give me $500 a month, you will have $36,000 in 6 years. And she's like, I'm in. Sounds like a plan. I was like, thank God. Where
I
she's
guess-
gonna get this money, I don't know, but she got to figure that out next.
Do we want to tackle this one? I retired in 2024 and have done nothing with my 401k plan that I contributed to for 38 years. Withdraw or roll over? Well, let's think here. Obviously, it's
I remember for a financial guy. I don't
Oh,
know.
okay.
So I can't.
I'm not. There are too many.
It's so many options.
There are too many moving pieces to this to give a good answer. The only answer I can think of is if you don't have a financial advisor at your financial institution, get in contact with one. That's something else. I don't know if you all know. I keep talking about having a banker at your financial institution. However, there are these other people that work at financial institutions called financial advisors. It does not cost a penny to go in and talk to one of them. You can schedule an appointment. Ask all the questions that you want to ask. That's a perfect one that you should ask a financial advisor. They can sit down and come up with a portfolio for you and show you how your money can work for you. So if you don't ever talk, I know we're the digital age and everybody does everything from home, but if you don't physically go into your bank and find out who the people are, I say bank, it could be credit union too. And you don't find out who the people are there and what services they can offer you, you're selling yourself short because there's so much more that you can get out of your financial institution.
Right. And with 401ks, I mean, if you were to take out the money, then it also depends on if you're already at, where you have to start taking automatic distributions.
Right.
There's a lot of variables. Right. But you also have to think, like, if you just take it all out, are you now going to spend it? Like, if you can put it in something that's giving you a monthly payment or a monthly check, that's that may be a better option. But again, it depends on your budgeting. I mean,
and most financial advisors also have ways of taking that 401k money and saying, okay, how much of it do you need to have liquid? We can put it in this that's going to earn you more interest and greater dividends than what we have it in here. That's the reason you go in and have that conversation so that you can get the most out of your money. We all work hard. I mean, this is my side hustle. This is not my, I don't know how people do this as full time. The stress would have me crazy. But anyway, but
I'm trying to get over my fear of being on camera so that I can do little FAQ videos. It was supposed to be on my business plan last year, and I just kind of kicked it.
I'm going to tell you what, you're definitely coming back. Misdemeanors are regular, but we're definitely having you back on, Colleen.
Thank you.
Absolutely.
Fun.
Yes. All right. Let's see. Do we have any more questions?
I had some that people asked me last night to just touch on, so I don't know. I can throw it out there. And
sure.
Some people wanted to know what's the difference between DTI and LTV.
Oh, that's a good one.
Yeah. So debt to income ratios versus loan to value. Yep.
So debt to income is what do you make gross?
Excuse me, Colleen. I just have to stop you for a minute. There is a really good comment saying you're amazing, Colleen, and you look beautiful.
Oh, thank you, MJ.
I want you to show everybody the fantastic sweatshirt that you are wearing.
My new sweatshirt. I got it.
We do not care club. DJ.
You have not watched that.
Thank you.
She is awesome. She's so funny. I love her. I got a bonnet. My daughter got me one for Christmas, like the Melanie Saunders has on.
Well, you can continue. I just, that was too important to not interrupt you. So carry on, lovely.
Oh, what was it? Oh, DTI and LTV. So your debt to income is what do you make? And you take your gross annual figure, divide it by 12, and then you add up what's on your credit report and include your housing payment. And then you divide that number, and that's your debt to income ratio. So a lot of programs, whether it's a mortgage or an equity line or credit card, they have their max debt to income ratio in order to qualify. So oftentimes, if you want to apply for a certain type of product, you can kind of work the math backwards to figure out how much you should ask for. If you want to increase your credit line, you might get $4,000, but if you ask for $5,000, they might say no. So just as an example, and then the loan to value is what you borrow versus what the value of the property is.
Right.
And whatever you may owe on it. Like if someone is looking to figure out what equity is available in their, because that's been a common question in this tonight. So let's say your home is worth $100,000. Most creditors, most lenders will only go as high as an 80%. Sometimes some of them will go 85% loan to value. So that means of that $100,000, you have $80,000 or $85,000 available. But if you have a first mortgage that, let's say, you owe $40,000 on, your actual available equity is really just $40,000 or $45,000. It's not the full amount. You have to figure that first. Your existing mortgage needs to be figured into it. It isn't just, I have $30,000 equity, let me get 30 grand. Yeah, it doesn't work like that.
That's where, I always say, financial checkups are something you should really aim to do annually. If you've got different financial goals in a certain time frame, then more often. But checking where you're at, because like you said, you can access the equity. It might make the best sense mathematically now for your financial situation to get that equity line, but 2, 3, 4, 5 years down the road, it might cost you less money to consolidate those two and maybe some credit cards or what have you, take money out to fix the house. So it's always good to check in because, worst case, you do the math and the answer is it's not worth it to do it right now.
Right. And the other thing to keep in mind with HELOCs and HELoans, you don't pay closing costs, unlike you do when you refinance. Most of them are no closing cost loans. You don't have to pay a dime to get access to the equity that you've built in your home. So just wanted to throw that out there.
And then someone else had asked me about first time. What does it mean to be a first time home buyer? What that means is that you have not been on a deed to any property in the last 3 years. The benefit to that is there are programs geared to first-time home buyers, which allow for, say, 3% down or 5% down. As a first-time home buyer, you could be eligible for down payment assistance or grants, things of that nature. And there's also a loan level pricing adjustment that they have for the interest
FHA
rate.
loans still only require 3%, correct?
Yes. Yeah.
And half of that 3% can be gifted. Is that still the case also?
Actually, FHA current guidelines, I have to be careful because they could change. Tomorrow. But 3.5% down and $500 has to be of the borrower's own funds. The rest could be gifted.
Oh, they did change it then. Yeah. Okay. It's been a while since I did first mortgages.
The HUD guidelines, the whole thing's online. It's like 1,800 pages.
But people think they have to have thousands and thousands and thousands of dollars to buy a home, and that is just absolutely not the case.
No.
And so I always make sure that people know that you can get into a home for 3.5% down.
Yeah.
So you take
we'll focus on, they might let you go if you have the right credit score and some money in the bank for closing costs, 0% down. Some of them are dictated by area. Some of them are, Community Reinvestment Act programs that each bank or credit union will have on their own personal portfolio. And then they, retain the servicing and all that. But there's definitely opportunities out there, and it doesn't hurt to see where you're at and then come up with a game plan and execute it eventually.
And just for clarity, what that means when we're talking about 3.5% down. So say you're looking at a house that's 100,000, you take 100,000 times 3.5. That comes out to $3,500. So that's the minimum down payment you would have to put down based on a house purchase of 100,000 plus closing costs. So for under 10,000, you could potentially get yourself into a home, again, depending on the price. So just to throw a calculation out there.
Terry, I think that was one of the things that we touched on a little while ago about accessing. Janet was talking about accessing the equity. So,
I mean, I think that's more, should you continue to
I think she's asking have a
borrow?
home equity loan.
yeah, that's what it sounds
okay.
like. Equity line or a loan.
So I'll present you this scenario. You know, if right now, if you have paid off your home, congratulations, first of all. Like, that's amazing. Because again, most of us don't stay in our homes for that long. So, but here's the thing, some things to consider. If you're coming into your retirement years, now you may want to have an equity loan. Most of them have a 10-year draw period. So you may not need the money today, but if you need it in the future and now you need access to money, you may not necessarily, based on your fixed income, qualify for a brand new equity loan, depending again on your situation. But if you already have an equity loan, because you've paid off your house, you're not paying any interest if you're not using it. Like I said, it's a credit card on your home. So if you don't use it, you can just leave it there, and that could be, you know, something comes up, you need a new roof, there you have your equity loan. So I said,
say to people now too, like, if you are looking at a first lien on a home that you already own, if you needed the money right now, you know, say if you're going to say a first lien mortgage cash out versus an equity loan, you might see better rates on a mortgage versus an equity loan. But if you want that flexibility because you don't need access, you just need the access right now, not the actual money in your bank account. The equity line, I think, is a safer way to go because no balance equals no payment.
exactly.
Also be careful if you are close to paying your house off and you're asking that question about having a home equity loan, get the home equity loan in the second position right now, because a lot of financial institutions have a lower maximum that they will allow in a first position home equity loan. I don't know why it doesn't make any sense to me, but a lot in banking doesn't make any sense.
We don't make the rules, we just follow them.
Exactly. So get it while you still have a first mortgage, so you can have the higher line, and instead of waiting until you've got it paid off, and then you're going to be stuck with, I can only get like a $75,000 line of credit. Maybe you want a $300,000 home equity line of credit. You can get that behind a teeny tiny first, but if you don't have that first and they max you at 75,000, that's all you can get.
It's all like a math game. It's like the perfect snapshot. Keeping your ducks in a row so that you have the perfect snapshot to do that.
I think Terry is saying she's months away. Do it now before it's paid off, then, while you still have that lien there. Go talk to your banker and find out if they have any sort of limitations like that. If they don't have limitations, then take your time. But most of them do. And so you want to jump in there while the iron is hot.
Right. And typically it takes, on an equity, you can close on an equity within 30 days. Like, it's not like a mortgage. They do a quick title rundown. They'll do an AVM and, you know, you're ready to close. So what else do we
ask me to talk about homesteads?
Oh, okay. Okay. There we go.
Yes. So what a homestead is after you purchase a property, I think it's like $50. It's really not that expensive. And what the homestead does, it protects your equity up to a certain dollar amount. You automatically protect it, I think, up to a certain dollar amount, but the homestead increases that amount so that if a creditor tried to come after your property, they can't. So it's a good thing to have. It's not a bad thing. Everybody should have one. If you have a house and you have not gotten a homestead, pony up the $50 or whatever it is and have it recorded. It's worth it.
And you can do that also when you're buying your home too. So you don't have to wait to own the home. That's something that you can ask for as you're purchasing your property. Ask for the homestead. Usually it was
You only have to do it
250. Right. You only have to do it once.
Yeah.
And it's
so
easier.
If there's more than one owner on the deed, though,
Each one.
you each want to have your own, just
Yeah.
because it protects more of the equity, your interest in the property.
Okay. Yeah, good topic.
Oh yeah, Terry, she said, do it. That's right.
Do it.
Do it. I love it. I love it. I love it. I love it.
All right. So what else? What other questions? Did you have any other questions that came up?
And then someone asked what the difference between cash out and no cash out was. And so that's basically, no cash out would be considered if we are only paying off the first lien on the property, or a first and second lien if they were both used to purchase the property. A cash out would be anything in excess of. So generally speaking, if you have one mortgage on your property and you just want a lower monthly payment, we'd look at the numbers and we would maybe cover the closing costs with the loan amount, but nothing else. So you're not really, I think we have a little bit of wiggle room. It's like give or take $2,000. We got to, you can't get more than that. Otherwise they lower the loan amount type of thing. And those rates for no cash out refinances are usually a little bit more beneficial than a cash out. A cash out's generally higher because we're giving you more money. So there's a risk. So that's, generally a little bit higher of a rate. But
this question,
the differences between the two.
Yeah.
I want to touch on this question here on like a side quest. So let's go ahead and answer this question. And then I want to add to this something that every single person that I come in contact with, I try to make sure they do to protect themselves. But we'll answer this one first.
All right.
Our question isn't worded correctly. It's fine, DCN. It's fine.
We understand. Is a homestead take place of a beneficiary if something happens unexpectedly?
Not that I'm aware of.
That at all, actually. I think you're thinking of maybe a trust.
A trust
would be, in essence, a person doesn't own the property, the entity does, and the trustees are in charge of it. So they would have a list of beneficiaries. List of beneficiaries is very important. It's one of the only things that doesn't get recorded. So you always want to make sure if you have a trust, you have the original signed one somewhere very safe so that once it's needed, it can be, you can avoid a lot of probate court, basically.
Right. And it's always good idea to put your house in a trust, especially as you're approaching your retirement years. This is something that I like to recommend because what happens is that they, if you end up, they do a 10-year look back. Social Security does a 10-year look back. So if you end up having to go into a nursing home and you've owned a home, they're going to go after your asset. But
property, yeah.
Right. So if you have your house protected in a trust, obviously the earlier you can do it, it is a little bit of a pain in the neck when you're trying to refinance or because you have to sign all the.
Sure that it's a revocable trust, because if it's an irrevocable trust, if you put
most
your property
lenders
into an irrevocable trust, they can't foreclose if you don't pay, so they don't lend on it. And in essence, you could make your access to your equity like nothing. So I mean, some people want it that way, but I've seen people do it that way by accident, and then I wanted the other kind, so then they have to pay to undo the trust and then pay for a new trust
because it gets recorded at the registry of deeds.
Change of ownership, so it can get very complicated if you don't do it the right way. So I always definitely talk to attorneys about trusts.
The thing I want to make sure every single person is aware of and does to protect themselves is, if you don't know what a beneficiary on your bank accounts, don't know what a beneficiary is, sometimes they are called PODs, which is also referencing
payable on death.
Payable on death. Every single person should have a POD or a beneficiary listed for every single bank account that you have. And the reason I say this is because when something happens to you, not if, we are all going to die one day. I hate to inform you all. I don't need to mean to be a Debbie Downer, but it's going to happen. Hopefully not for a really long time. But when that day comes, whoever is listed as your beneficiary can go into your financial institution with a death certificate, a copy of your death certificate, and they will have immediate access to those funds, which you want because you need someone to take care of whatever bills you have that need to be taken care of when you are no longer on this earth. So everybody should have that. Mr. Demeanor and myself have a beneficiary on every single account that we have, so that if something happens, that is accessible immediately. It is not the same thing as a power of attorney. Power of attorneys exist when you're alive. Payable on death exists when you're dead. The power of attorney is going to go away the minute that you pass away. So make sure that you put a beneficiary or a payable on death on every single one of your accounts. If you do nothing else.
Because if you don't,
it goes into probate.
It goes into probate, and that means that your survivors, your would have to go through the courts to get access to that money, and it's expensive and lengthy and a mess.
It's a mess. Don't do it.
Even if you have all of your paperwork together, you have your will and you have your this and your power of attorney and your trust and your this and your that, it is still a lot of work. Like if you don't have somebody on the bank accounts, whoever's in charge has to get this money and get these bills paid.
And they can't. And they can't. And in a lot of cases, trust me when I say I have worked a really long time. This is the most frustrating thing to do to a family member that has lost a loved one. And it's even more frustrating to the person sitting in the financial institution having to tell the person who's crying at their desk because they need to pay funeral expenses and they don't have access to any of their deceased loved one's finances or money. It's Please, just like the very first thing you need to do tomorrow is find out, if you don't have this, find out how to get a beneficiary listed on every single one of your bank accounts.
DJ is saying someone can still challenge it in court. Not if you
not a POD.
Not a POD.
It doesn't even go to court.
It doesn't.
Does not even go to court.
Talking about
oops.
There are things that you can have in your will, what Colleen was saying. That you can have it all listed, all your ducks in a row. Someone can come up and challenge you.
I can't hear him.
I can hear you, DJ.
Oh, you could. So that's what I mean. I don't mean the POD. I wasn't making reference to that. I mean that you can have things in your will and designate a beneficiary, but people can challenge that and they can tie up money that you need to use for funeral expenses and other things. And somebody, especially if you have a lot of money, and there are greedy people out there, if there's anything we've learned, we know that in this community. So anyway.
Oh boy, you just went there, didn't you, DJ?
I'm authorized. It's my show.
No, I know, of course. I guess technically somebody could challenge
it's easy to. You can get around it by putting a clause in. Anyone contests it, they get $1. I mean, that's what most people do in their will. If anyone contests what the directions are in the will, then they get $1.
Right.
Ask Joan Crawford. Anybody that was on my Ask Me Anything live stream knows I'm all about Joan Crawford and Betty Davis in Old Hollywood. So that's why I know that.
All right. So ladies, I think we're going to go ahead and maybe start wrapping it up here. I think we've covered a lot of ground today, and I am very happy with everything we've been able to cover here. We've gone from credit cards to mortgages to retirement to silver. Silver and gold. But yes, so we hope that everyone got some valuable information. And if you learned anything, make sure you have your PODs set for all your accounts. Make it easier for your loved ones.
Check your credit score. Add your PODs.
Yes. Know
And
that you
yes,
can use the CD for a loan. It's a lower interest rate. You don't have to have a CD in a lump sum. You can divvy it up. Yes. Yes, all the things.
do all the things.
Make good
And-
choices.
Love it.
You guys were fire. You guys absolutely killed. As good as we thought this episode was going to be, because we were going to do it just for Bia. It was just going to be, and then she had the round table. As good as we thought it was going to be, it was even better. Like, look at the chat right now.
Yes.
Aw.
Thank you,
Amazing.
everyone.
You
Yes.
guys killed it.
I have like new glasses. They're the progressive ones. So I have to sit here so I can read this. So I can't even see it. Yeah, I'm gonna.
That's okay.
You keep seeing me go like this because it's two different prescriptions, and so the font is different on all the things.
Well, ladies,
Oh my hot mess. That's what I should have done.
Well, Bia, I want to say thank you so much for having me on this evening and hosting this fantastic topic for all of us to discuss. I'm honored that you thought to have me on. I'm just
Thank
a
you.
calendar keeper
Same.
lady.
I'm copying what she said. Thank you so much. I was so
no
glad.
problem. And thank you, Mary Malarkey. She says, I agree. Go inside the bank when Pat I started reading it here and then it jumped. Oh boy, hold on.
I can read it for you.
Okay.
When asked suddenly, I walked in barely holding it together. The man inside helped me make a list of everything I needed to handle, like 75 things I needed to do. The stranger was my lifeline. Yes, get to know your bankers. They're just people like you and everyone else, and they're wanting to help you. So let them.
Absolutely.
Yes. Yeah, that's what we're here for. That's what they pay you to do.
Exactly. So on behalf of Miss Janet Demeanor, her show will be in the, she has a wonderful YouTube show that will be in the show notes. And Colleen, we've put her website and that will also be up on the show notes. Thank you for joining us tonight. We'll see you on the other side.
Thanks so much.
Bye. Thank
Make
you.
good choices.
Yes.